if we're thinking green economy, if we're thinking, copper, we're thinking nickel, we're thinking lithium, we're thinking, all these sort of commodities, where do they come from? They come from the earth. And then how do we get them out? How do we make them into a product that the technology companies can use? Well, it's happening in China, it's happening in Korea, it's happening in Japan, it's happening less so in the States. When will these countries start adapting and building the infrastructure to take the raw material into the refined product before they stick it in their Tesla or whatever? That's going to be the question about supply chains in the end. If the States keeps poking the bear with respect to China on the supply chain, then if something happens, then it's sort of like, okay, where do you get it from?
Welcome back to Liberty and Finance. We have two first-time guests today. I don't think I've ever been able to say that before, but this is a panel. We have Joe Mazumdar and Brent Cook from Exploration Insights joining us this Monday, August 10th, 2020. Guys, thanks for coming on the show.
Yeah, thank you.
We had the pleasure, Joe, of having you visit us in the booth at the Sprott Natural Resources Symposium that just finished up about 2 weeks ago. Brent, we weren't able to quite connect because your schedule didn't allow it that day, but we're glad to have you both here now. And one of the things I wanted to follow up with from that visit was some of the eye-opening awarenesses that I received on some of the geopolitical dynamics that are accompanying new infrastructure improvements that are being made, investments, frankly, by major world power countries such as China around the world to shore up their relationships with many different countries. And as we're looking at what are going to be, people who follow our channel are often concerned about some of the geopolitical risks. And one of the things they're concerned about is shifts in balance of power between major countries. They're looking at the US dollar, for example, as the world reserve currency, and that's partly based on US's privileged position as such a dominant world power. But Joe, if you could maybe kick us off with some of that discussion that you were leading us into when you visited us at the Sprott Symposium about some of the strategic relationships and that strategic approach that goes far beyond like this year's profits or that sort of thing that China in particular and maybe others are using to establish those beachheads into strategic resources in the world that are going to be making a big difference in the next decade.
Yeah, I guess, the background is that, the COVID-19 pandemic has really, I guess, accelerated the view of supply chains for specific countries. Like, where am I getting this? Can I depend on it anymore? That sort of a philosophy now, or the implications of that for companies, for countries, has accelerated, and they're thinking more and more about that. So usually with geopolitical risk on the Western companies, we look at it like, are they going to tax us higher? Are they going to impose more royalties? Are they going to expropriate the asset, sort of thing? Whereas, some countries, specifically the Chinese, they look at it multifaceted because they've got 10-year plus plans, economic plans, and they understand their growth, or they're forecasting the growth for the entire country, what commodities they need. So then they pick places that they could actually work in. So they will help those countries with viable projects, support facility, roads, rail, whatever. But in the end, that may help them and probably will help them get, let's say, iron ore out, or a copper project going, or uranium, something like that. So for a Western country, that's probably not economic, because they don't have the wherewithal to build a port, to help you with the infrastructure, the political ties, to help that specific country, because they're not connected all the way up. They're just one company. Whereas these state-owned companies in China, they're all linked to what the greater objective is of the country, good or bad. And so now, like if we look at, something like TMAC, TMAC was looking to get acquired, and I believe a state-owned Chinese company is making the acquisition. And this is in, the Arctic, It's near the ocean and that, and people are now questioning whether the Canadian government or even the Americans want the Chinese up there. With now what's happening with climate change and the potential to use those waterways more, do they want a Chinese company with a foothold there? So all those questions are being asked. The Australians have asked those questions a lot, and they're sort of looking with their Foreign Investment Review Board more heavily with respect to investment by certain countries in the country. So you got a few different things happening with respect to companies investing in certain countries and those countries that are getting invested in with respect to, do they want these countries countries to actually be investing significantly in specific assets and commodities.
Right. Just to underscore one thing you said there, because it leaped out to me when you said it, and the last time we spoke about this, so I have the benefit of that previous conversation that some of our viewers don't have, is that you were saying that unlike, say, North American companies, mining companies or whatever, who may have this fiscal year and next fiscal year, that's their focus, as well as they've got the limitation of just the borders of their corporate charter, their corporate mission, and their corporate assets to deal with. That you've got these Chinese companies who basically have the force of the 100-year plan, whatever you want to think of it as their the governmental plan, as well as the depth of the banking support and that kind of thing, and the ties with, okay, we want to go after that copper mine, but you need, like you said, you need a marine port installed. Okay, well, we have the ability as a country to come in and put an actual seaport in for you. Oh, you need rail lines? Okay, we have the capability as a country to come in and put in rail lines for you. We can even bring not just the technology, but the capital and the workers to do all that for you. So here you've got this potentially impoverished country who is rich with this natural resource that's getting their infrastructure improved for them by this mega power that can come in and do that. And incidentally, we'd like to have access to that mineral that you've got there. And you also talked about the mineral being strategic for China. Can you talk to us about that part of it?
Oh, absolutely. I mean, the thing is that China is not a resource-rich country, and there's a lot of people that consume a lot of commodities, but it doesn't have a lot. So what they try to do is get the value add. So if they're looking for copper, they're looking for copper concentrate so they can feed their smelters. Feeding their smelters adds value. So if they're looking for steel, they're looking for iron ore. They'll buy the iron ore, they'll buy the metallurgical coal, but they will value add in their country, and in the end, they'll produce the finished products. And then those finished products will go to the world. Now, the question is right now, with the supply chains and all the U.S. trade tensions with China, does some of that industrial production come back to Europe, come back to the States, come back from China? So that's going to be basically the question. And if you do that, then do you need to secure that commodity? Do you need to actually build refineries and smelters in your own country? Because basically that's what the Indonesians have been doing. They've been requiring people that build mines, copper mines, to actually build the smelter, because then they send the refined copper, a value-added product, to China, and not the copper concentrate, which sells at a discount to copper. So all these people are looking at how I get more out of my own commodity. But the problem is some countries don't have the leverage to do that, and other countries do. They can negotiate better. They're at a better a point in their economy that they can actually work with them.
You made a further point about the strategic thinking about the necessity of certain elemental minerals or whatever in the future economy, or filling an essential gap in a production plan that's way out there. Can you talk to us about the fact that, again, in the Western world, our plans are often quite short-sighted in terms of what's at a decent price now, what's profitable right now, that kind of thing, versus that more strategic form of thinking that we're competing against.
Yeah, I would say the most, analogous to what China does are the big diversified miners. They look 10 plus years, 20 plus years out, because their iron ore mines last for 30 to 40 years. Their copper mines last for 30 years. So they tend to look long term. in terms of where they are, and they'll explore in countries right now that you may not think are geopolitically, the countries you want to be in, but in 10 years they might be. But they look at it differently from China in that they're not going to build a port. They might not be able to build the road, but they might try, and that's one thing BHP tried to do in Guinea, but they couldn't make it up in terms of the return on capital. But the Chinese don't think like that. Their economics are different than how a Western country would think about it, because their investors, their stakeholders want them to return an investment on their capital. In China, it's different. What they want in the end is the commodity to feed the machine, to make the product, to keep their economy going.
I think it's also to keep in mind that Chinese corporations or companies, government controlled, they're able to work under different rules, if you will, than Western companies. So that gives them quite an advantage in securing a metal or a deposit. And a lot of the infrastructure that they build up, I've seen it all over in Africa now, that doesn't come free. That comes with hooks. And so you're playing by two sets of rules, and it makes it a lot more difficult for a company like BHP or Rio Tinto versus a Chinese government-controlled entity.
What about specific minerals that are going to be important strategically in a future economy, the rare earth elements and things like that, that aren't really getting the mind share, or there's presumptive access, like, we can get those globally, we can access those from those other countries, and you're saying, no, that global supply chain isn't always going to be as intact as it has been in the past. So can you talk to us about some of those more strategic elements?
If you look at things like gold and silver, companies can produce a final product with no problems. The problem becomes that when you produce the intermediate product, like companies don't produce nowadays a lot of refined copper. They have to produce the copper concentrate, which goes to the smelter. All the smelters are in Asia, whether it's the Japanese, Koreans, but the majority of them are in China. So even though you might say, okay, hey, we need electrification in the States, we need to build electric vehicles, we need more copper, but you're not going to actually smelt that copper. You're going to end up buying that refined copper, if that's what you use, from China or from Korea or from Japan. You might have better relationships with the Koreans and the Japanese, but still the majority of it might come from China. And so the question becomes, do the Europeans, do the Americans actually want to build these refineries, these smelters, all these other industrial stages of production to actually get, because you could produce copper in the States, that's not a problem, but all that copper concentrate goes to China, and then it'll come back. So is the States willing to actually do that at home? Because it's been a very significant NIMBY issue in the States to actually, build a refinery. There's hardly, most of the problem with oil was 10, 15 years ago, when the oil prices went up, is because they could get the crude oil, but they couldn't refine it because there wasn't enough refining capacity in the States. Are they willing to do that? Because the resource, it's not as if the U.S. is resource poor. It's not. The problem is that the Americans and the Canadians and the Australians send all that product to Asia to be refined and also potentially to become an ultimate product, and then it comes back to the West.
This is fascinating because we've been hearing for over a decade or two or three about the impact to the Western economies from all this huge offshoring that was being going on over our economy, over our industrial capacity, of our jobs over the past 3 decades or so. And this is an entirely different lens to look at that through, but it's quite startling, isn't it, that the COVID lockdown response and everything that came with it has really put a sharp relief on the dependency, the frailty of that assumption, that presumption that you can always count on a global supply chain. Just distribute your production wherever you want in the world, it'll all work out. Yeah. It's like, sometimes it won't. So how does that impact the strategic plans of each of these nations in terms of being able to deal with those natural resources effectively to meet their legitimate demands going forward?
Yeah, and that's, do they start making the same sort of multi-year plans like the Chinese? The problem that we elect officials every 4 or 5 years, depending on the country. And they only make plans for that 3 to 5 years because they worry about getting reelected or they don't get reelected. Not everybody's Vladimir Putin. So then it's sort of like I'm making a short-term plan every time. And then the next guy comes in and all he does is change the short-term plan the last guy does. He spends the first 3 to 4 years just doing that. Then he hopes like hell he comes in the next year, then he can make an actual plan. And by the time the next guy comes in, he just changes everything the other guy just did.
Well, you mentioned NIMBY a little while ago, so that's not in my backyard. So that's the other thing, and some of that is almost like putting blinders on. In the Western world, we've wanted to take in the moral high ground and say, we're going to do this virtue signaling of saying, we're a green economy now. We don't do this dirty stuff like anything having to do with mining or refining and smelting and all that sort of thing. And yet, everything we use, as David Morgan reminds us, either grown or mined. So we rely on that to happen somewhere. That's an interesting aspect of how do we confront that back to, look, if I'm going to use these products, I need to take responsibility for how they are produced. And sometimes if I want to make sure that happens, I got to do it closer to hand. But you also talked about some changed practices that are some are more successful than others to prevent some of the traditionally concerned environmental effects of some mining, such as a collapse of mines where they leave vacated holes underneath the ground, or dumpings of tailings and they leach into the groundwater. Can you talk to us about, and Brent, as far as some of the new practices and how viable some of those are proving to be?
You want to go, Brent?
You go ahead, Joe. You're doing great.
Okay. Yeah, I mean, a lot of people fear, like in British Columbia, we had the tailings dam, failure at Mount Poly, I believe, and that instigated a whole bunch of changes in how people put together tailings dams. We had the big breach in Brazil as well, which was more horrific, and so people are worried about things like that, justifiably. Some of the problem is really related, like especially in British Columbia, in my opinion, is it was related to the inspections. The inspections and the ability to inspect this was once a year or something like that. And the companies need those inspections. And it was really, in the end, the company's issue, because it wasn't tailings that made it breach. It was actually the amount of water they sent into it, because they could not get a permit to actually take that water and actually put it into the environment. That was actually the issue. And every issue might be different. But underlying that is that if we're thinking green economy, if we're thinking, copper, we're thinking nickel, we're thinking lithium, we're thinking, all these sort of commodities, where do they come from? They come from the earth. And then how do we get them out? How do we make them into a product that the technology companies can use? Well, it's happening in China, it's happening in Korea, it's happening in Japan, it's happening less so in the States. When will these countries start adapting and building the infrastructure to take the raw material into the refined product before they stick it in their Tesla or whatever? That's going to be the question about supply chains in the end. If the States keeps poking the bear with respect to China on the supply chain, then if something happens, then it's sort of like, okay, where do you get it from? Where do you get these products from? So I mean, that's a bigger issue than we're going to tackle here right now. But definitely COVID, the pandemic, and the ongoing trade tensions with China, between them and the U.S. You go ahead.
So rare earths are sort of a unique situation in that they're, copper you can find all across the globe in various geologic settings, but rare earths are very unique in terms of where they're deposited, and even more important, they're, for the most part, chemically bonded, so that you need to break that bond to get them out. So processing those is very, very difficult and expensive, and very few deposits are amenable to that. So rare earths is kind of a unique situation in terms of like copper and lead and zinc, nickel. The Chinese or wherever eventually has to sell to somebody. And I don't think that's as big an issue as some people think. But in terms of the rare earths, that's a difficult one.
And they produce a lot. They actually have rare
Right.
earths in China. So in terms of there being resource rich or resource poor, they're definitely resource rich in terms of rare earths. And I believe the U.S. Government is now looking more strategically at rare earths and uranium and some of these other commodities, and trying to look at building stockpiles and things like that. So I mean, they are looking ahead, but I would say the companies are farther ahead than the countries, especially the West, with respect to looking out into the future, because that's what their company's all about, is future uranium price, rare earth, copper, whatever. So they tend to look out 10 to 20 years, whereas the individual country may not. And more importantly, it's the consuming companies, like whether it's the Tesla or somebody like that that's actually consuming these raw materials, and they're saying, well, where are we going to get this from? Those are the people that have a better insight into what's going on than the governments right now.
Well, that's leading into Blackstone, which is an Australian company. We bought in Exploration Insights. They've got a nickel deposit they're proving up for development in Vietnam. But the key there is a Korean battery maker, nickel battery maker, is now moved into the country, and they're looking at, there's a deal there to be made where the battery company can get the nickel from Blackstone and process and make the batteries right there in country. So that's the sort of thing Joe was just talking about. That's sort of what we're looking for, is where there's a unique situation that we can see where the metal is actually going, and how it's going to be used, and who's going to finance it.
Yeah. I mean, with that situation, that's a unique one in the sense that, LG Chem came into that country with this billionaire Vietnamese conglomerate that wanted to build a battery plant there because Vietnam has cheap power and cheap labor. And they didn't even know that there was nickel in Vietnam until these guys started exploring and finding it. They made a deal with a different company, a Korean company called EcoPro. And once you get into the battery manufacturing, there's different products. And so by negotiating and making a deal with one of those kind of companies, when you make a nickel concentrate, you might sell it at a 70% discount to the price. When you can make a more advanced product, you're suddenly selling it at a premium to that price because you're selling a nickel sulfate or something else. And it's that ability to get closer to that product that goes into a battery is can be significant. Going from a 70% of the price to 120 or 125% of the price.
Capturing more of the value chain.
Value add. Yeah.
We have a question from Holistic APRN. So a lot of what you do, and I'm going to ask you more about what you do, is to evaluate these different companies and the markets in which they reside and the position that they're taking strategically in that. Holistic APRN asks, when evaluating a gold exploration company, how do you interpret integrity and moral character of that company?
Go ahead, Brent.
Oh, wow. Well, I mean, key, and Joe is real key on this, is does he feel comfortable, or do we feel comfortable with the people running the company in terms of, are they honest? Are they invested in the company themselves? And are they technically competent to run the program that they're proposing? If they're looking for a epithermal gold deposit in Argentina, for instance, do they have that skill set to make that discovery? So it goes all the way to that. And I think once we're comfortable with the company management is honest, knows what they're doing technically and financially, then it comes down to the property, which is, in the end, that's what's important, is that property they're exploring, does it have the potential to produce a deposit that's significant enough to really impact the share price? And I would say 90% of the companies we look at, the project they're actually evaluating, even if they're successful, is not going to have a significant impact on the share price, particularly when you consider the risks, the high risk nature of this junior exploration investing. So that's sort of where we go. And when we go to a project, until COVID hit, we were looking at 30 projects a year. And it's all about not just what the rocks are saying, but you get there and you take a look and what's the infrastructure? What's the strip ratio might be? What's it going to cost to build a road in here? What do the locals think of the project? Is there a church on top of this thing, et cetera, et cetera? So it all comes down to that. And that's why so few of these exploration projects ever actually turn into a real deposit. And that's why gold sells for over 2,000 an ounce. It's really hard to find an economic quantity of it.
When we were beginning to talk today, Brent, you mentioned that we should probably talk about the valuations that a lot of mining companies may be receiving in this current market season and market environment that we're in. Can you shift the discussion, maybe both you guys, to talking about that for a moment and where you see us both in the broader bull market phase or whatever for precious metals, but specifically in the mining shares and where we've gotten? Are we ahead of ourselves? And is it specific to all shares or ones that people might pick because they don't have the depth of insight that you guys do with your analysis?
Well, I mean, like Brent was saying, with all this analysis and all these fatal flaws that we tend to look at, our ultimate goal with the junior companies is, where it's very high risk, potentially high reward, is the potential for it to get taken out or built, meaning that it's something worthy. When you pick something that's of value, you've got downside protection, that this is actually something real. The problem is right now, not the problem, the good problem, whatever, is, with gold and silver going up, all boats are lifting, even if they got big holes in them. They just hold their water a little bit longer. The issue right now is we can tell somebody, this is not going to work, or take a look at this, or blah, blah, blah. I don't own it, but it'll probably still go up. And it does, The problem is if the market is volatile, when we come on the other side of the market and then the price goes down or people are not interested in these equities anymore. I mean, in the last cycle, gold price kept going up as the equities started falling before that. And so if you pick these assets run by quality people, as Brent was saying, that appear to be, amenable to a potential M&A takeout, then you protect your downside. It's a lot more work to pick these companies, but the filtering, you don't have to look at 900 companies. You can get down to a select few very quickly and just focus in on those. So you might miss on a 4-bagger here and a 5-bagger here, but you might get a legitimate triple bagger with limited downside risk, in terms of, hey, I held it too long. This might not be an issue here. So that's why we feel like it's still worth doing that work as opposed to just picking any company that a certain, mega billionaire investor buys, or one that says silver on it, or something else that that's got something everybody. The greater fool theory works in a certain window, and after that it stops working. Once all those fools leave and there's nobody else to buy your share. So you want to be out before that. So if you're going to play that game, you're going to have to watch the news flow a lot tighter than a company that you trust, that a company the asset is something worthwhile.
Yeah, I'm trying to make sure I get the message here, and I think what I'm hearing is that for people who are amateur investors who are just, they've heard something about a company or they just figure it has gold or silver in the name or something, people who don't have that analysis behind them and are just picking things that seem to be going up, we're getting into some real frothy territory. I think that, Brent, that's maybe what you were saying earlier. If you don't have that depth of analysis of understanding the fundamentals and the strategic prospects of the companies.
I can give you an example. I'm not going to name a company here, but so our subscribers ask us about companies, and so I looked at this one company for one of our subscribers, and he made, 4 times his money on it. But now he's questioning it. Ooh, the valuation's gone up. What should I look for? And then we've looked at this company before, and then we were worried about the grade continuity. We were worried about the size of it. And then when I looked at the financing, here was a project that's in Canada. It's gold's going to 2000 or whatever, and they financed for, I don't know, 10 to 15 million, but they did it all super charity flow through, which seemed kind of weird considering there should be demand for that. And super charity flow through is sort of like, not, you're not selling it to interested shareholders. You're selling it to people that are looking for a tax write-off. So in 4 months, when that hole comes off, you're going to get a lot of disinterested people that don't care about the asset at all that'll be selling their shares. But then that says something about the asset or the people, that they had to go down that path to actually go to a super charity flow through to actually get finance, as opposed to doing hard dollars. Why wasn't there any hard dollars? Was there no demand? So that would be a question to ask. And so for people that don't want to do a lot of due diligence, technical due diligence, look at the financing structure, because we're seeing a lot of people getting financing. So did they do a warrant? Did they trade up after? Because we see a lot of people trading up after the financing is closed because there was so much additional demand. So those are the sort of things you could look at without doing potentially the technical due diligence, but just looking at it from a different perspective and reading the tea leaves of the financing.
What you're describing, though, even is beyond most of the reach of most investors. So what services do you guys provide if they want to avail themselves of that expertise that you're going to bring to the party? It sounds like you do both field work and actual site inspections and that sort of thing, as well as looking at the finances of companies and their strategic positions. Can you tell us what people are going to benefit from if they use your services?
So Exploration Insights has been around since 2008. Brent founded it, and he bought it from this guy, Paul Van Eden, who was a broker. And so when Paul Van Eden ran it, he was running it from the point of view of a non-technical broker that looks at the broad market. Then Brent came in, and then he changed it to look at it technically. Hey, let's look at these companies from the exploration point of side. Do these rocks actually, look good? Is this grade going to hold up? Blah, 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 blah. I bought Exploration Insights in 2016. And so I do a lot of the same stuff Brent does, but also I've got a bit of a different background and a slant on it. But basically what I try to do now is basically tell people what I'm buying or selling and why I'm buying or selling it. And so our due diligence, we buy big companies for leverage. So when you see that cycle about when commodities go up, the first ones to actually go up would be the cash flowing ones. And so we would buy a few of those to get leverage. But then as the market keeps going, then we moved to developers and the explorers, which were several of the companies I've just recently purchased. And what you'll get with Exploration Insights for your monthly subscription, which is cancelable at any time, is a download on those companies, updates with respect to them, insights with respect to what's happening in the market in general. And if you have a question about a specific country that I could add value to, or Brent can, we will respond to that in our own sort of forum in the website. And so you'll get access to our portfolio, active portfolio, the closed things that we have, and then you'll have access to all the newsletters back to 2008 if you want to look at, because a lot of these projects come and go. So we might have talked about them 5 years ago, and the rocks haven't really changed that much. So a lot of that stuff is still worthy of review. And that's the sort of thing you'll get an access to these archives for a weekly letter that publishes, 48 issues a year. So, that's basically it.
We'll include a link in the description of this video so people who want to find out more can get right to that. Brent, I had a follow-up question, if you'd be willing. Has this lockdown and all of the travel bans and that sort of thing really impacted your ability to do the go and see that you were accustomed to in terms of first-person evaluation of a lot of these prospects?
Not significantly. I mean, I've been doing this my whole life, and so has Joe. We've been to a lot of projects, seen a lot of geology, and have a good sense of these projects. Plus, a lot of these are just recycled. I've been there. There's one that I looked at just yesterday, changed the name. This is the third time I've looked at it. It hasn't changed. It's still crap. But so, it comes around and around. And I'm still able to get around in the U.S. 2 months ago, I went and looked at some projects up in Idaho and Nevada, just drove there and got a good feel of them. And Joe can visit stuff in Canada. So we can still get out. but we've got enough background experience, I guess, to really be able to evaluate most things that come our way.
Yeah, for me personally, yeah, my schedule has changed quite a bit. I used to travel, maybe 25% to a third of my time, a lot less now. But saying that, given the volatility of the market, a lot of the trades that I made that were ended up being highly profitable, I might not have been able to make if I was traveling. And so being on the market during these volatile times with COVID has been a plus with respect to monitoring a lot of the names and managing the portfolio. But as Brent says, with respect to site visits, it's a way for us to get on site to see and basically help our subscribers to relate what we see or read in the in technical reports or press releases to what we actually see in the field. And I think that's very important. But I don't need to go to everything. We get more invites to go on site visits than I'll actually do because after a while it just becomes a waste of time. And I think the other thing about traveling and what COVID has shown me is the amount of time lost in traveling between getting to the airport, traveling, waiting for a flight, getting to the hotel, driving from that, doing a one-day site visit, and then coming back. And that's like 4 days blown for one day on the site visit. So it's really opened my eyes with respect to making sure that whatever site visit I go to is a significant value add or definitely a company that we might add to the portfolio.
Well, any final thoughts you have for our subscribers? And a lot of our viewers are not yet subscribers. If you're not yet a subscriber, make sure you click on the subscribe and the little bell icon so you get notified of new releases. But Joe Mazumdar and Brent Cook from Exploration Insights, any final thoughts for our viewers about what you offer them and what they need to keep their eyes open for as we head into this next year, decade?
Well, one thing I would suggest is a word of caution here. We're seeing right now hundreds of millions of dollars flowing into the junior sector, more or less indiscriminately. When the rocks start talking, I mean, when the drill results come back and that, a lot of these are going to look, the reality is going to hit the wall, if you will. And there's a cliff coming 4 months out that I would be very cautious of if I was investing in this sector. Joe?
Yeah, I would say the same. Like a lot of the times, like even though, private placements seem to be attractive, that 4-month hold can be like handcuffs. As you see the drilling results coming out and you go, ooh, geez, that doesn't look good, blah, blah, blah. And the guys that bought free trading shares after the private placements are in a better position because the market is volatile and junior stocks, drilling, related news flow is volatile and you don't want to be handcuffed sometimes. And a lot of these companies that are good are not offering warrants. So the idea of actually getting the share in the private placement versus paying a little bit more free trading, it's probably with the risk of the 4-month hold, it's probably better just to buy it in the market nowadays.
Well, and for people who want to be armed with the insight that your analysis will provide them, they'll find that at explorationinsights.com. We've been speaking with Joe Mazumdar and Brent Cook from Exploration Insights. Guys, thanks for joining us this first time on Liberty and Finance.
My pleasure.
Thank you very much.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.